In September 2008, several European banks stopped trusting each other overnight. Money was still in the system, but it stopped moving normally. According to archived records, central banks had to quietly step in within days. Most people never noticed anything unusual at the time. Cash machines kept working, salaries still arrived. Stores stayed open. Behind the scenes, something fragile had been exposed. It was not a single bad bank. It was not one reckless country. It was a shared structure that connected banks across Europe. This story focuses on Europe. It focuses on its banking system. It focuses on how that system was built and why it behaves the way it does today. By the end of this video, you will understand how European banks became deeply dependent on each other, and why that dependency still matters. One retired bank clerk in northern Italy later said he noticed something odd that week. Internal transfers that usually took minutes began taking hours, then days. No explanation was given at the time. Most Europeans were told the crisis had passed. But some of the underlying problems never fully went away, so the question is simple. How did Europe build a banking system that looks stable on the surface, yet repeatedly needs quiet intervention to keep functioning? The real story does not begin in a crisis. It begins decades earlier with a quiet goal. European leaders wanted money to move freely across borders. In the late 1980s and early 1990s, Europe was preparing for deeper integration. Trade barriers were being reduced. Capital controls were relaxed. Banks were encouraged to operate across multiple countries. At the time, this seemed practical. If companies could sell across borders, banks should lend across borders too. According to archived policy papers, officials believed risk would be spread more evenly. One overlooked detail mattered. Banks were allowed to grow large across countries, but supervision remained mostly national. Each country watched its own banks. No single authority saw the entire system clearly. A former regulator in Spain later recalled how routine this felt. Banks expanded into neighboring countries with little resistance. Balance sheets grew quietly year after year. Very few people asked what would happen if stress appeared everywhere at once. The system worked well in calm times. Credit was cheap, growth felt steady. Problems seemed distant. But this structure carried a hidden assumption. It assumed trouble would arrive slowly and locally. That assumption would not hold for long. The first real shift came in the late 1990s. Europe introduced the euro in 1999 as an accounting currency. Physical notes and coins followed in 2002. This changed how banks operated almost immediately. Currency risk between member countries was removed. A loan made in Germany now looked similar to a loan made in Spain or Italy. Interest rates began to converge. Southern European countries suddenly borrowed at rates close to Germany's. According to central bank data, cross-border lending surged within a few years. Large banks gained influence quietly. They could raise money in one country and deploy it in another with ease. National regulators still focused mainly on domestic stability. An analyst in Paris later described the period as deceptively calm. Balance sheets expanded without raising alarms. Risk models assumed markets would remain liquid. Ordinary people noticed the change in subtle ways. Mortgages became easier to obtain. Property prices rose steadily. Credit felt abundant and safe. Power was shifting from national banking systems toward a tightly connected network. Few questioned whether that network could absorb stress. At the time, the benefits were visible. The risks remained abstract. At the center of Europe's banking system sits a simple mechanism. Banks lend to each other every day. They do this to manage short-term needs for cash and liquidity. This market is often called the interbank market. It allows banks to function smoothly without holding large piles of idle money. In calm conditions, it works quietly in the background. The mechanism depends on trust. Each bank must believe the others are solvent. Each must believe collateral will hold its value. One common illustration comes from overnight lending. A bank in France might lend funds to a bank in Italy for a single night. The next morning, the loan is repaid with a small amount of interest. Millions of these transactions occur regularly. According to archived records, this system grew rapidly after the euro was introduced. Banks assumed that shared currency meant shared safety. Risk was priced as if national differences no longer mattered. A former risk manager in Frankfurt later described internal meetings from that period. Stress scenarios focused on individual institutions. Very few models considered a loss of trust across the entire network. When trust holds, the system looks stable. When trust weakens, the same mechanism can amplify fear. This quiet dependence would soon become important. The first visible consequence did not arrive as a collapse. It arrived as hesitation. Banks began holding onto cash longer than before. According to internal documents later reviewed by regulators, interbank lending volumes started to shrink. This happened quietly. There were no public announcements. One indicator was subtle. Banks began parking more money at the European Central Bank instead of lending to each other. They earned little interest, but they felt safer. This behavior was not expected. The system had been designed to keep money circulating. Instead, it began to pool in safe places. An employee at a mid-sized bank in Belgium later recalled internal memos changing tone. Language shifted from growth targets to liquidity buffers. No one used the word crisis. Ordinary customers noticed small changes. Loan approvals took longer. Credit limits stopped rising automatically. The system was still functioning, but it was doing so more cautiously. What had once been automatic now required reassurance. The quiet confidence that supported daily banking had weakened. And once that confidence faded, it proved difficult to restore. As caution spread, institutions began adjusting their behavior in similar ways. What started as prudence slowly became coordination without planning. Banks across Europe reduced exposure at the same time. They shortened loan durations. They demanded higher quality collateral. This created pressure in unexpected places. Companies that relied on rolling credit faced delays. Smaller banks found wholesale funding harder to secure. Governments noticed the shift indirectly. Tax revenues softened. Bond issuance schedules grew heavier. According to reports later published by the European Commission, several member states began guaranteeing bank liabilities. These guarantees were meant to calm markets. They also tied public finances more closely to private balance sheets. One Treasury official in Ireland later described late-night calls during this period. Decisions were made quickly. Details were filled in later. The system was still holding together, but every safeguard added weight. Each intervention increased dependence on confidence. What had once been a flexible network was becoming rigid. And rigid systems respond poorly to shock. The pressure became visible during moments of renewed fear. One clear moment arrived in the summer of 2015. Capital moved rapidly out of southern Europe. Banks shifted funds toward Germany and other perceived safe places. Target 2 balances reacted almost instantly. Germany's claims jumped sharply within months. This movement was recorded by the Bundesbank and the European Central Bank. According to published figures, the increase was measured in the hundreds of billions. Inside institutions, this was seen as a stress signal, not a crisis, but a warning light. An economist present at the time later described screens updating faster than expected. Outside, nothing dramatic happened. Shops stayed open. Salaries were paid on time. The system held. But the strain was no longer invisible. Looking back, the pattern becomes clearer. Germany did not set out to take on Europe's risk. It stepped into it gradually through rules meant to hold the euro together. Each safeguard pushed pressure toward the strongest balance sheet. History shows this pattern repeating in monetary unions. Stronger members become anchors when weaker ones strain. The process feels technical, but the result is political. Risk concentrates where trust is highest. According to insiders, this was understood but rarely spoken aloud. Public language focused on stability and solidarity. Private discussions focused on containment. The question was never about winning or losing. It was about keeping the system intact. And once that path began, turning back became difficult. The effects of this pattern did not end with the crisis years. They still shape Europe today. Germany's central bank continues to hold large cross-border claims. These balances move as confidence rises or falls. During periods of market tension, they grow. During calm periods, they shrink only slightly. This influences debates about inflation, interest rates, and fiscal rules. German savers notice long periods of very low returns. Governments argue over responsibility and fairness. The structure remains in place, unchanged in design. According to recent data, Germany still carries the largest share of internal euro system risk. This is not a forecast. It is a continuation. The past is still present in the numbers. This story leads to a simple conclusion. Germany did not absorb Europe's debt risk through one bold decision. It happened through systems, guarantees, and steady acceptance. Each step felt reasonable at the time. Each step reduced panic and brought calm. Over time, calm carried a cost. History offers similar moments where stability depended on one strong center. The center rarely chose that role openly. It inherited it. Germany's position today reflects that inheritance. Not as a villain or a savior, but as a pillar holding weight placed there by design, the question now is not about blame. It is about understanding. And what understanding might change next time pressure builds.